You know how money used to move? Basically, at the speed of business hours. If you sent a wire transfer on a Friday afternoon, well, you'd be lucky to see it before Monday morning. But that's all changing. The U.S. financial system is getting a massive upgrade to its core plumbing. It's called FedNow, and it really is a foundational shift in how money moves in America. And just to wrap your head around why a new system like this is such a huge deal, you have to get a sense of the scale we're talking about. The global payments market. It is enormous. We're projecting it to be a $3.1 trillion industry by 2028. For decades, the U.S. piece of that pie has been handled by a mix of private companies and, frankly, some pretty old tech. So that's the key question, isn't it? I mean, in a market that's already packed with innovators like PayPal, Zelle, and Block, why would the central bank decide to step in and build a whole new system from the ground up? Well, the answer tells us a whole lot about where finance is headed. See, the launch of FedNow isn't just some tech update. You have to see it as a strategic move into this massive market. It's really a fundamental decision by the Fed to say, okay, we're going to modernize the country's payment infrastructure ourselves, providing a public option for instant payments. Okay, so let's get right into it. What exactly is FedNow? It's a term you're going to hear a lot, but it gets misunderstood all the time. First thing to know, it is not a consumer app you can just go and download on your phone. The key word you really need to focus on here is infrastructure. Think of FedNow as brand new, high-speed rails for the entire banking system. It's the plumbing, the behind-the-scenes network that lets banks and credit unions settle payments instantly. We're talking any time of day, any day of the year. So you don't interact with FedNow directly. Your bank does. And to really appreciate why these new rails are so revolutionary, we first have to take a look at the old tracks. You know, the ones the U.S. has been running on for almost 50 years. That legacy system is the Automated Clearinghouse, or ACH. It's the workhorse behind pretty much everything you're used to, your direct deposit paycheck, your automatic bill payments, tons of other transfers. But it was designed back in the 1970s, and here's the kicker. It processes transactions in batches, not one by one, and that batching is exactly what causes all the delays. And when you put them side by side, the difference is just stark. With the old ACH system, you're stuck with business hours, and settlement can take 1 to 3 days. With FedNow, it's instant. It's 24/7, 365. The funds are final and available to the person on the other end immediately. For the banking world, this is like jumping from dial-up internet straight to fiber optics. It's a massive leap. So, we know the what and we know the why. Now let's dig into the how. How does a payment actually travel on these new, shiny rails? The absolute foundational promise here is constant availability. Money never sleeps, right? For businesses, this means way better cash flow management, especially on weekends and holidays. And for all of us, it means no more waiting for a check to clear over a long weekend. The money just moves. The process itself is actually pretty simple. So a bank kicks off a payment, FedNow instantly validates it, and then settles the transaction between the two banks' master accounts, the ones they hold at the Fed. Then the receiving bank gets notified and credits the recipient's account. The whole thing happens in just a few seconds. And if you look under the hood, it's all built on modern tech. It uses something called the ISO 2022 messaging standard, which is a fancy way of saying a lot more data can travel with a payment. Think an invoice number or other details. It's also got sophisticated tools for banks to manage their own cash and to fight fraud in real time. Okay, a new, faster system is great. But what does it actually mean for the market? How does this change the financial landscape? For operators, for investors, for everybody? So this is a really crucial point. FedNow is not a monopoly. It actually operates alongside a private sector alternative, the RTP network, which is run by a group of large banks. So what this means is that the U.S. now has 2 parallel, high-speed payment networks, and that creates both competition and a whole lot more resilience in the system. This quote just nails the long-term outlook perfectly. As instant, low-cost payments become the standard, entire business models are going to shift. I mean, think about insurance payments, payments for gig workers, or just-in-time supply chains. That economic gravity of cheaper, faster transactions, it's just incredibly powerful. And you don't even have to guess at the Fed's strategy. You can see it right in their own fee schedules. Looking out to 2026, FedNow fees are planned to stay right where they are. But fees for old-school paper check services, they're set to rise and rise significantly. That's not an accident. It's a crystal clear signal to the market, adopt digital, and move away from paper. This is just a classic long-term infrastructure play. The Fed isn't trying to make a quick buck on FedNow, not at all. The goal here is widespread adoption. By keeping the fees low, they're encouraging every single financial institution out there, big or small, to get on these new rails. So after looking at the market, the mechanics, and the whole strategy behind it, what are the key things you really need to remember about this whole transformation? First and foremost, this is so much bigger than just sending money a little bit faster. This is a generational upgrade to the core plumbing of the US economy, and it's designed to support the digital, always-on world that we all live in today. And it's also really important to have a balanced perspective here. FedNow is going to enable all sorts of new services and products, for sure, but ACH isn't just going to disappear overnight. The two systems are going to coexist for years, with each one serving different needs. This is an evolution, not an overnight revolution. And that leaves us with one last, kind of provocative question to think about. As the friction and the cost of moving money fall this dramatically, what new business models, what new services, maybe even what entire new economies suddenly become possible for the very first time? This is not financial advice.